The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. As global markets face heightened uncertainty, Singapore-listed companies are standing out for their ability to deliver steady income to investors. As of August 2025, the average dividend yield among local firms is around 5%, offering a reliable income stream even amidst economic volatility. With the U.S. Federal Reserve having their interest rate cuts for the first time and signaling more to come, market fluctuations could increase, making dividend-paying stocks an attractive stabilizer for investors. So to find out more, I'm joined now by Dhanesh Sharma, who is the Financial Services Manager at PhillipCapital. Dhanesh, welcome to the show. Thank you so much for joining me today.
Hi, thank you for having me.
All right, Dhanesh, well, Singapore-listed companies are offering an average dividend yield of around 5%. So what does this tell investors about the current state of the local market?
Yeah, so I think the fact that Singapore-listed companies are offering an average dividend yield of around 5% indicates that the market is prioritizing income and stability over rapid growth. This suggests that many firms are maintaining strong cash flows and disciplined capital management, even in a slower economic environment. This also reflects investor demand for steady returns, which supports companies' ability to continue paying dividends. For investors, this signals that dividend-paying stocks can be a reliable way to generate income while managing risk. From an income perspective, this is particularly notable. A 5% yield from a quality stock is very competitive with other fixed income alternatives like bonds, making it a compelling option for clients who are focused on building a resilient income stream. The market may not be delivering the same capital appreciation as high growth assets, but combining dividend stocks with other portfolio holdings also allows investors to achieve a balance of income, resilience, and modest long-term growth, particularly amidst global economic uncertainty.
Okay. Well, then, with global uncertainties and now U.S. interest rate cuts, what challenges and opportunities do Singapore investors face today?
So Singapore investors are navigating a market shaped by unpredictability and changing global financial conditions. While local fundamentals remain stable, fluctuations in global growth, trade, and corporate earnings can lead to short-term volatility. Companies with higher debt levels and less predictable cash flows may be more exposed to these shifts, making careful stock selection crucial for investors focused on income and capital preservation. At the same time, U.S. interest rate cuts present clear opportunities for local investors. Lower yields abroad make Singapore's dividend-paying stocks comparatively more attractive, offering reliable income and a measure of defensive stability. This is a key point when advising my clients on their fixed income portfolios. As rates drop, the global search for yield intensifies, making Singapore's dividend stocks with their attractive yields stand out even more. By focusing on companies with strong earnings, sustainable dividends, and resilient business models, investors can generate steady returns and position their portfolios to weather both domestic and global market changes.
Okay, so with this backdrop, what factors make Singapore's dividend-paying stocks resilient in today's global economic climate?
Yeah, so I feel Singapore's dividend-paying stocks are resilient because they tend to come from sectors with stable and predictable cash flows, such as banking, utilities, telecoms, and certain REITs. These companies typically maintain conservative payout ratios and strong balance sheets, which allow them to continue paying dividends even when earnings fluctuate or the broader market experiences volatility. When advising clients, I emphasize that this resilience also comes from the quality of the companies themselves. Firms with consistent earnings, disciplined capital allocation, and a history of stable dividends are better positioned to weather economic slowdowns or shifts in global financial conditions. Much like evaluating the creditworthiness of a bond issuer, we look for companies with a strong foundation. For investors, this means that dividend-paying stocks can offer both reliable income and a degree of defensive stability in uncertain markets.
But how can investors then differentiate, between companies with sustainable dividends versus those at risk of cuts?
Yeah, so investors can tell a lot about dividend sustainability by looking at financial fundamentals such as payout ratios, cash flows, and earning stability. Companies that distribute a reasonable portion of their profits while keeping enough for reinvestment or as a buffer against slower periods are more reliable. Strong free cash flows relative to dividends is another good sign that payments can be maintained even in challenging times. From my experience advising clients, these are critical metrics Just as we would analyze a company's ability to service its debt for fixed income investment, we analyze its ability to cover its dividends. It also helps to consider the company's sector and business model. Firms in stable industries with predictable demand are less likely to reduce dividends than those in cyclical or capital-intensive sectors. A history of consistent dividend payments over multiple economic cycles further indicates that a company is committed to rewarding shareholders, giving investors confidence that payouts are likely to continue.
Well, then can dividend stocks serve as a hedge against market volatility or risks stemming from potential U.S. interest rate cuts?
Yes, definitely. Dividend stocks can help hedge against market volatility. The regular income they provide can soften the impact of falling share prices, giving investors a steady return, even during periods of uncertainty. This is a key reason why I recommend them to clients seeking income stability. In addition, as U.S. interest rates potentially fall, dividend-paying stocks in Singapore may become more attractive compared with lower-yielding alternatives abroad, which can support their market value. The defensive nature of these stocks comes from the quality of the companies behind them. As I said before, firms with stable earnings and strong cash flows are better able to maintain these dividends, which can provide both income and some capital stability when markets swing. For investors, including dividend stocks in a portfolio can offer a combination of predictable returns and resilience against broader market risks.
Well, that said, which sectors, such as banking, REITs, utilities, telecommunications, and industrials, have historically provided, stable dividends?
So historically, sectors with predictable cash flows and essential services have provided the most stable dividends. Like you said, banking, utilities, telecoms consistently deliver reliable payouts because their earnings are steady and less sensitive to short-term economic cycles. Real estate investment trusts, or REITs, particularly those focused on commercial and industrial properties, have also been dependable due to long-term leases and recurring rental income. Industrials can also provide stable dividends, especially companies with established contracts or a global customer base. For investors, these sectors are attractive for income-focused portfolios because they combine regular dividend payments with lower volatility, making them a core choice for those seeking predictable returns.
Well, are there any, emerging trends or sectors investors should watch for stable income in the current market environment then?
Yes, absolutely. So REITs, particularly those focused on industrial, logistics and data center assets, continue to provide reliable income due to strong tenant demand and limited supply in these segments. For instance, as of June 30th, 2025, Keppel DC REIT posted a 12.8% year-on-year increase in distributions for the first half of 2025. With a portfolio occupancy of 95.8%. Similarly, Fraser's Logistics and Commercial Trust delivered a 6.7% yield with an occupancy rate of 92.5%. High occupancy rates indicate stable demand for these properties, while rising distributions suggest that cash flows are being effectively passed on to investors, making them attractive for those seeking predictable income. The healthcare sector also offers opportunities for stable income. Hospitals, clinics, and diagnostic services can generate recurring revenue, underpinned by Singapore's aging population and growing regional demand for medical services. Raffles Medical, for instance, maintains a forward dividend yield of around 2.45% and a policy distributing at least 50% of sustainable earnings. These disciplined dividend practices reflect the sector's potential to provide consistent cash flows, making healthcare a complementary option alongside REITs for income-focused investors.
Well, what strategies can investors then use to position their portfolios to withstand potential shifts driven by U.S. monetary policy?
So I feel investors can start by diversifying across asset classes and sectors to reduce vulnerability to interest rate changes. Allocating to dividend-paying stocks in defensive sectors such as healthcare, utilities, and essential services can help provide stable income even if broader markets fluctuate. Including a mix of cash or short-duration bonds can offer flexibility and liquidity to respond to these shifts. When advising clients, I stress the importance of having a fixed income component to their portfolio. It provides a stable anchor and a source of liquidity that can be deployed to take advantage of market dip. Assessing the financial resilience of portfolio holdings is also crucial, as companies with low debt and stable earnings are better positioned to maintain dividends when rates change. Monitoring dividend coverage ratios, reviewing earnings reports regularly, and adjusting allocations gradually rather than reacting abruptly can help investors manage risk while continuing to capture income opportunities in Singapore's market.
Well, speaking of diversifying portfolios, how can dividend-paying stocks complement other income-generating assets in a broader portfolio?
Yeah. So I feel dividend-paying stocks provide a steady income. They can balance more volatile assets such as equities or commodities. Their predictable cash flows help smooth overall portfolio returns while allowing participation in potential capital appreciation. In a low interest rate environment, dividends can also enhance total yield compared with traditional fixed income instruments. When combined with other income-generating assets like bonds, REITs, or structured products, dividend stocks can improve portfolio diversification and reduce reliance on any single source of income. From my perspective, this is crucial as a well-diversified portfolio should not rely on a single income source. Dividend stocks also provide flexibility, allowing investors to reinvest dividends to compound returns or use them as a regular cash flow stream, supporting both short-term needs and long-term wealth accumulation.
For a retail investor in Singapore today, what would be your top 3 considerations when investing in dividend-paying stocks?
Yeah, so for retail investors, I want to highlight a simple 3-point checklist that can help with making informed decisions. First, evaluate the stability of cash flows. Companies with predictable revenue streams and low earnings volatility are better positioned to maintain consistent dividends, which is particularly important in a period of potential interest rate shifts and market uncertainty. Second, consider management quality and capital allocation. Firms with disciplined spending, prudent debt management, and a clear commitment to dividends are more likely to sustain payouts through economic cycles. Understanding management's approach helps investors differentiate between companies that treat dividends as a priority versus those that may cut distributions when under pressure. Third, examine long-term growth prospects alongside yield. A stock offering a reasonable dividend yield with opportunities for gradual earnings growth not only provides immediate income, but also helps preserve purchasing power over time. Combining yield with growth potential allows a retail investor to achieve balance between income generation and wealth accumulation, supporting a more resilient portfolio in a changing market.
Well, overall then, Dhanesh, how should investors monitor their portfolios to adapt to changing economic conditions and interest rate movements?
So I feel that investors should adopt a structured and proactive monitoring approach, regularly reviewing the portfolio allocations and assessing how different assets respond to economic shifts. Tracking macro indicators such as inflation, interest rate expectations, and sector-specific developments helps investors anticipate potential risks and identify opportunities to rebalance their holdings. When advising clients, I stress the importance of understanding how a change in the interest rate environment can affect their holdings. For example, a rising rate environment may favor certain fixed income assets over others, while a falling rate environment could enhance the appeal of dividend-paying stocks. In addition, incorporating scenario analysis or stress testing can provide insights into how portfolios might perform under varying interest rate or economic conditions. Regularly evaluating dividend coverage, earnings quality, and liquidity ensures that income streams remain robust, allowing investors to adjust strategically without compromising long-term objectives or exposing the portfolio to unnecessary volatility.
Some great tips from you here. Thank you so much, Dhanesh, for joining me today.
Thank you so much.
Thank you. That was Dhanesh Sharma, Financial Services Manager at PhillipCapital. This has been The Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
Money FM 89.3